All right, so we finished the week on not so bad. It was a down day, but not so bad of a down day, as we'll talk about as I show you some of the indicators here. Again, a prevailing theme that we've had that I brought up on Wednesday. Obviously, I was out on Monday, but that theme has continued throughout going into this week, and I think will continue into next week. So I'm going to break that theme down some more in case you forgot, or in case you might have kind of been wrapped up in like especially yesterday's big move higher. To maybe thinking that kind of changed the narrative or the theme. So we'll reiterate that, take a look at how these indicators were impacted by the last couple of days of moves, and see what we should expect. A big move in bonds this week, big move in the dollar. So we'll break down how those are impacting where we expect equities to end up going, what's driving a lot of this, especially from a sector perspective. Not necessarily the best leadership this week. We'll break down why. And again, we'll take a look at our trade idea in one of those areas that has been leading the market that we might take advantage of. That maybe it probably is not as was probably more bullish than it should have been, as you see by today's move in that particular stock. So we'll talk about how to trade that. And again, reiterate our goal on YouTube is to get to 10,000 subscribers. So thanks for those who subscribed on Wednesday. And again, if you haven't, most of our viewers we notice aren't subscribers. So let's try to get us up to that 10,000 mark with your help there. So let's go ahead and get started. Today is Friday, April the 14th, 2023. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get going too far, I invite you to subscribe to our YouTube channel with this icon here or the red subscribe button down below. Click the thumbs up icon to like our video, comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, check out some of these other things over here on the page, including the Market Outlook Live over here on the right and some of our other resources and posts. Come down to the bottom, click this heart. It opens up this tab. Click that like button. Same thing here. Click this thumbs up icon. Opens up this tab. Hit that like button. Again, the more you do that, it really helps us. It helps get our content out to all of our followers there. So we always ask for it day after day. We're well above 100 the last time, so thank you very much again. That's a big number for us. We like that, so let's keep that up. For those that are liking us, thank you. Let's keep it up. For those who don't, you can do it right now while you're watching with one or two really easy clicks. All right, let's go ahead and start off taking a look at the S&P 500 with the market forecast indicator like we always do. You can see we actually finished, we were down today, but we finished up off of the lows, so that was actually a pretty decent close, relatively speaking. Again, but considering the trend, like we're still easily on this bullish trend, dark green shading and the green line, intermediate lines above the 90th percentile. That's strong. Like this last go around, it didn't get above the 90th percentile when we had the exhaustion day. It did like just barely. And this is not just barely. 92nd percentile is pretty clear. We did get above it over here on that run, and really got above it on that August fake out move. Of course, the question being, is this going to be another fake out move or not? You can notice this entire time that we've been bullish on the intermediate line, the momentum line is not, like from the time that we developed the low point until now, the momentum line, the red one, never has gotten into the reversal zone. Like you can see over here, from the time that we hit the low point, it got in the reversal zone barely there. It got into the reversal zone easily there, kind of midway through. You can see on this one, as coming off of the low point, it got the first day off that October lows, it got in the reversal zone. It got in the reversal zone there, and there when it ultimately ended. But multiple times over here, it got into the reversal zone when it started off of the low point with that runaway gap, and then it got in the reversal zone again there and there and there. So plenty of when we're bullish, the momentum line gets in the reversal zone, and that allows the near-term line to get in the reversal zone too, because the near-term line follows the momentum line. In this particular case, the near-term line's gotten in the reversal zone once on the initial surge without the momentum line. It came off the low point with a little bit of a surge on the near-term line, again, without the momentum line getting up there. And then now your near-term line can't quite get and stay above there because the momentum line hasn't gotten there. And that's kind of the idea. And again, why I think this might be the peak for the near-term line here going into this next week. Because again, the momentum line can't get there. And the momentum line has gotten into bearish territory. The near-term line hasn't. right? So there's been 3 attempts on this current near-term rally, essentially, with the momentum line dropping twice into oversold levels, once to almost extreme lows, and the near-term line didn't follow suit either time. So I think we're kind of playing with fire here in terms of how far and how long the near-term line can stay up here without the momentum line, and how long the near-term line can avoid getting down here after so many attempts of the red line getting to that point. Of course, market sentiment still falling despite a strongly bullish intermediate posture, and 3% above. Now it's only been 3% above. We can't quite get going further. You can see on some of these other instances here, you've gotten over 5% above, and you've definitely gotten over 4%. So if you look at the 4% mark, you can kind of see easily the intermediate moves got to the 4% mark. The highest point this one's gotten to is 3.7, which you can see again easily on these other fake out moves, no less. We've gotten higher. So we can't really get a strong move going, which has been kind of a theme really all week long. Usually Dow Jones Industrial Average, again, looks very similar. Though, it's had a really good strong run here lately when it started off so weak relative to the rest of its peers. The NASDAQ 100, you can see started off more bullish and has been kind of waning here. Has been sideways the last couple weeks. Its momentum line did get there. But the other thing, too, to keep in mind, I didn't bring this up on the S&P. I'll bring it up here in a second. You can see that the NASDAQ is playing, sitting right at this resistance, trying to get through it, right? You've been up and down and up and down and up and, quasi down. And so it's trying to get through this resistance while, it's getting closer and closer to its moving average. The S&P is also sitting at a really important resistance level from a Fibonacci standpoint. Very, very important, just like the NASDAQ. As you can see, we're sitting right at this kind of 4150 area, plus or minus a little bit, which is where you've got the 50% retracement of the correction, and then the 73% retracement or 78% retracement of this of this move that we've been retracing this entire 6-month period practically. That we can't get below the 23, we can't get above the 78 and stay there. So remember, that's when you get your move and you start to retrace. You start to retrace when you get above the 23%. You stop retracing when you either get above the 73 or whatever that is. Is it 78? 78. So when you get above the 78, or when you get back below the 23, and we've done neither, right? We've just been in between those lines, and pretty much in between the 38 and the 78 for however many months, 6 months now. So it's hardly been able to maintain a strong move up there to the upside. So there's that. If you take a look here at, let's see here. Let's go back to this regular. We got a little bit easier to see there. Though it did bring, what I noticed, it did bring these lines. These lines need to stay on there. All right, let's take a look at the Russell. We didn't look at the Russell 2000. So the Russell 2000, it got the bear tag, so the light green shading yellow line that, again, the S&P got one, and the Russell's gotten them before, and when you follow through on the bear tag with some strong bullishness afterwards, then great, right? That's what leads you to, to a new intermediate run. So as of right now, we haven't followed through with that bear tag with more bullishness. And if we get back below these lows, then that pretty much would nullify that bear tag, obviously, and you would have to hope you get another one. The intermediate line is flirting with the market sentiment line, still actually below it, and your near-term line, again, coming down to where the momentum line has been. So now it did get down here before, whereas the S&P, remember, did not, the near-term line, but it's looking like it's making its way down because the momentum line actually got to extreme lows here. So you would expect the near-term will get down into most likely the reversal zone at some point sooner rather than later as well. Let's take a look at the S&P on the weekly chart, on the weekly market forecast. So your near-term line, again, got much higher than the momentum line. So the momentum line did not get in the reversal zone, barely got in bullish territory before falling back into bearish. So again, not the best sign, right? That you do not want The near-term line too. I mean, you kind of had that here. The momentum line got in the bullish territory, turned down. The near-term line went a little higher, and it ended up being kind of a false peak here in May of 2000. We went down to those lows. We're heading up against resistance with the near-term line at levels that the momentum line says it shouldn't have gotten to. Your intermediate line's also setting up for a potential move. In our class this week, we looked at, there was another example of the intermediate line getting slightly above 80 on the weekly. See, when it gets above 80 in the weekly chart, you see it stays above 80 for quite a while. Here was one instance here in 15 where it got close to being above 80 and it failed, and we rolled over there to the downside. Let's see here. All these other instances, you notice like during this bear market, it only got to 50, barely got to 50. It didn't even get across it there. And this bear market over here, this was the example. So in April, March of 2000, the intermediate line also got barely above 80 and it failed. I mean, we had a really good 6-month run coming off of the COVID low point to the tune of the Copic curve, which was all the rage after this March close. The Copic curve turned bullish, right? And a lot of people said, hey, that's a 100% guarantee. Well, it's actually not 100%. It's like 90% because there's one instance where it didn't turn to good, strong 12-month returns, and that was that period right there in March, April of 2002, where we got up to the 12-month moving average and failed and rolled over. So we saw that's what the intermediate line got above 80 over there and also failed and rolled over. And you notice a very similar pattern developing here. The intermediate line is probably going to get above 80 next week unless we get a big down move. If we just kind of grind again with some candle like this, transition type candle, then you're more likely going to get the intermediate line continuing its momentum here slightly above 80. And more than likely, because of where the momentum line's headed and the idea that the near-term line will follow suit, it's probably going to roll over from there and get a move to the downside, and we're going to fail at that point and bring the intermediate line down with it, and of course, again, we'll be on another move. You see the likelihood of that happening is also showing up here. As you can see, the Heikin-Ashi differential has closed below its 3-period moving average, in this case 3-week moving average. So we did get a higher high, we did get a slightly higher close, kind of like here. Here we actually got a lower high. But the body is getting so small that we're starting, we're headed towards a reversal according to that pattern. Now, of course, you can get fake out. So, but until you get a fake out, you expect that you'll get the reverse, especially considering you're at pretty significant resistance levels there. You can also see that too on the whole moving average. We've been below the whole moving average for now over a week. That's a reversal sign too on this, but when you look at on the weekly chart, again, you can see the moving average again crossing the Heikin-Ashi, crossing below. We're still below the 200-week moving average of the whole moving average. So it looks like, and you can see we got 3 green arrows on the Russell, and immediately we got 1 red arrow back. We almost had 2. That was kind of flirting with it, but we got 1 red arrow back. We've got 1 red arrow on the Qs. We had 2 for a couple of days, but regardless, we don't have green shading anymore because we don't have 3 green arrows. The S&P still has 3 green arrows, so does the Dow. But the fact that the Russell couldn't stay green, because it's got to stay green for a day, for 2 or 3 days or more, to really solidify the 3 green arrows. Because a lot of times 3 green arrows can actually be a sell signal, just like 3 red arrows can be a buy signal if it can't hold it. And so, I mean that's how close we are to a new set of 3 reds after getting a set of 3 greens. I mean, the MACD is turning, the histogram's already peaked and rolling over and turning down. The stochastics was flirting all day Friday with the red arrow. So we're that close to getting another set of 3 red arrows, which would mean that this 3 green arrows is a sell signal. Especially, like I said, considering that you didn't follow up the 3 green arrows or the bear tag in the market forecast chart with a couple more days of rally, right, to really solidify it. To keep like this, right, like we had right here, to keep the trend bullish. You had a down day on the Qs, but we got the 3 green arrows and you continued to rally. It solidified it. It got above the moving average and stayed there. Same thing on the Dow. all these three. I mean, this is what you want to see when you get a 3 green arrows, and obviously we so far haven't seen that on the Russell 2000. Here's your S&P heading into that resistance, which is also the top of the value area. So this is the area, this purple shading between 413 and 377 is the shaded area of 70% of this year's volume is traded inside of that range. We're at the top of that range, which acts as a resistance. There's a big volume node, relatively big volume node there, and of course the Fibonacci levels that are so important. They're narrative changing. I mean, we get through this level, we're bullish. We're strongly bullish now. So very, very close to some very narrative changing levels. I told you the Qs also have the same element. You're above the value area barely, but you're at that volume node. You're at the major Fibonacci levels, and you're in a convergence period where the MACD is actually below and the stochastics are below their moving averages, even if we are still above the 17 days. So when you're in a convergence period like that, and the S&P is getting close to one, was flirting with that red arrow today as well all day long, it limits your upside. It's just hard to get going to the upside when you got that working against you there. All right, let's take a look at some of the other oscillators. Looking at the DMI, you look how low the pot. I mean, that's about as low as it's gotten. Aside from that fake out peak in August, this is about as low as the negative indicator has gotten. So it's, again, for as not bullish as we are, that's a pretty bearish level. Pretty bullish level for the negative indicator. Yet the positive indicator, of all the other instances back here, where including this peak right before the fake out up here. All the other instances that we were at this 16-ish level on the negative indicator, the positive indicator is higher on all the other instances. We're below 30, and we've been dropping. So again, convergence mode limits upside returns. RSI and CCI was flirting with, but it actually did get below 60 at the lows of the day today, and you can see we're not above 100 on the CCI, so we're flirting with staying. It's hard for it to stay in these bullish levels. Your average of the 4-week range, we're still at very strong levels of the 4-week range, but now your average is getting up here, so we're prone to breaking down when the average gets up above this 80%. And it's one thing to get, once the average gets up this high, to have already made a really strong run, right? Like, you've had on the S&P from this low point when we broke the moving average and we ultimately peaked, you can see we're up 10% there. Over here, when you hit that low point and you finally broke up above, and you peaked up here at about 14%. And then again, you can see over here when you broke up above it over here, you came off of this low point and you finally broke above, you're at 14%. So here, you're coming off this low point where you break up above the moving average down there, and we're currently at 7. And with the orange line already almost at the reversal zone. So again, a much smaller move relative to all these other periods where the orange line has really taken off. And it's not like we're coming off of real significant lows. It then goes to show just how not bullish we are, especially as we are kind of diverging here with slightly higher highs inside of a convergence period on equities. The McClellan oscillator dipped back down slightly below 35. It was actually in the 20s at the lows of the day today, but it's not that's not a bullish level anymore. At least it's not below 0, but it's also not, it's not at a level that sustains the trends when you're above 35, right? You want to stay above 35 or below minus 35 to sustain whatever trending move you currently have. The money flow really has taken off, so that's a relatively positive sign. It did get up to 72, but again, that's kind of a peak, right? That seems to be, the rest of the momentum. And then it kind of, we can still move higher, but you've kind of start to lose the momentum on that peak there. So it'll be interesting to see how that plays out. From a breadth standpoint, you're also still missing like the new highs and new lows. And look how bullish we are. Like on this peak right here, we actually did get positive new highs and new lows. We were at 10, which is not very high. You like to be above 100, but we were at 10. Back over here, when we were above 100, when we were at these levels before, we're at these levels again. Not only are we not above at 100, we're not even above 0. We're not even above minus 100. We're actually below minus 100. So the breadth just stinks. This is really, really bad breadth. And yes, I'm making a pun on that. We're just not getting, a strong move to the upside. When you look at how many stocks are above the 50-day moving average, we are above 50%, but we're not above the 60 level. We're not really clearing all these other times where we've been bullish. We've cleared the 60% level. Not only did we clear the mean, but we really kind of took off here. We're not taking off. We're getting stuck here at the 50% level. So as you see with the new highs, and it's just not strong enough of a rally. And then when you look at of course we're getting, a new high today, and we actually did close above last week's high, but you can see how sideways we've been for so long. And then you look at the VIX, right, and how the VIX dropping as dramatically as it has. Look at that drop all day on Friday, dropping all the way down to the 85% mark. The VVIX, you see the VIX way below all these lows. I mean, this is the lowest close since January of 2022. You have to go way back to get to a level that was this low. It was right January, let's see, it would be not that one, it'd be right there. January the 4th, the day before this whole thing started, was the last time we were below at least this low or lower. So here we are, but the difference here is, look how much lower the VIX got than this last low point it had earlier this year. The VVIX is not that low. In fact, it's very similar to that January period when we got to 17 and we were 85%. I think we were below 80% back in January relative to VXV. But you can see the VVIX also formed a higher low point then, just like it's doing now, and you can see what came out of that. And again, I'm actually expecting, we were pretty dramatically down on the VIX relative to its average values over whatever period, but especially when you look at the 200-day period here that we've been looking at, we are at the second percentile of how far down below the third percentile of how far down below the 200. I mean, that's an extreme low. We are, and the stochastics is really, really low compared to that peak earlier this year, the bottoms earlier this year. I mean, we are at extremes that, you worry about, when you get so extreme below a certain level, you just rebound pretty quickly. And considering that, when you look at the long-term view of this options expiration cycle about to end, it's not very common for us to close at the bottom of an expiration cycle. When we do, like we did kind of close to there, we had 3 consecutive expiration cycles of strong volatility. Otherwise, you notice there's a lot of lower shadows here on this monthly chart. I expect that we'll either get a bounce back up this week, considering how extremely low we are going into options expiration, or coming out of options expiration. I would start to expect the next expiration cycle, like a lot of these other really big periods with finishing at the lows, usually come after big strong rallies in volatility. You can see another one right there. This is not a big strong rally in volatility. The body's actually really small, much bigger body, and most of the range is the body. We still have another week right before next Friday, but the lack of a lower shadow, the big fat, there's such a strong range, how extremely low we are, again suggests that next week might be a pretty volatile week. All right, now let's talk about what's driving the price action here. Let me bring up the, let's look at the week, this past week here. So let's go to April, and we'll go over to April the 10th. All right, you'll notice that we had, a relatively kind of sideways week, especially for the NASDAQ 100. It was kind of flirting with the zero line. It was down most of the week until a late surge at the end of Thursday, and then was down negative today and then finishing the week strong. You'll notice IWM was up 1.5%. It was up, but that's not a lot. It was up more earlier in the week despite the weakness in the Qs. But bonds, you can see bonds really dropped this week, especially in the last 2 days. A big decline in bond prices. Let's take a look at what that meant for bond yields. Let's go to a 1 year. Let's just go to a regular 1 year chart. Let's go to this one here. And let's go to a 1 year chart on this. Give it a second to load up. There we go. All right, so bonds. There we go. The 10-year yield up above 3.5% again after being well below. And again, it's not bullish for bonds to be below, the yield be below 3%. It's not bullish for it to be above 4 either. So you're kind of about to enter a period where we might be actually a little bullish for equities. But it is, I mean, you are above the 17-day moving average clearly. The MACD has been in relative convergence mode for a while. Stochastics now getting above 50 for the first time. So like that's a pretty decent run. If you look at TLT, which we talked about before I left on vacation, that it was kind of poised for a breakout move, and it started to bust out there before pulling back. It's now pulled back to the 30-day moving average. And again, if we're going to be bullish, we want this to go down. Like we want yields to go up. We want this to go down. We want the Fed to raise rates. We do not want this to break out to the upside because that's going to be an illustration of risk aversion, not risk appetite. We don't want the Fed to cut rates by the end of the year. And that's actually a good thing too. You notice that the Fed is actually, the odds of a Fed hike have actually raised in the this last week a little bit, not very much, but in a little bit, up into the high 70s now. Here, let's refresh this page. There we go. So now up to 78%, whereas a week ago we were at in the low 70s. A month ago we were in the 30s. So we are expected to get a rate hike, but what we need is by the end of the year, we need the odds of a rate cut to drop dramatically. And they were, we did have very low odds of rate cuts before this financial, like when the rates were peaking here in early March. The odds of rate cuts were really low. You can see when we had this peak, it's taking so long, but right there at that peak right there. But you can also see now we're starting to get back up again. So we might be headed back in that direction. That's the most bullish macro case we can have. For the Fed to be able to raise rates maybe one, maybe two more times, and the market to be able to handle it, right, without necessitating rate cuts. And so that would mean that your yield curve would actually probably stay inverted. It's inverted at really extreme lows here, but it'll probably stay inverted, and you kind of want this to stay inverted for as long as possible, because the only way this uninverts, at least on a long-term basis, the only way this uninverts is that the Fed starts cutting rates. And the last thing we want is the Fed cutting rates, because that means the economy can't handle this 5% level, and all these leading indicators that are going to come out here pretty soon that are so negative, that are pointing to recession, among other factors pointing to recession, are actually going to play out, and actually, we will see the recession there. I think that's, I think the only time that we'll see the Fed cut rates is if and when, and I do think that's actually going to be the scenario that happens. That's the more likely scenario. But I think we'll be below the 200-week moving average by the time that happens. Again, we've seen that before in the 70s when they started to raise rates, or cut rates, below the 200-week moving average. It's actually one of the only times we've seen the Fed start a rate cut cycle below. Usually the Fed starts cutting rates up here, like in this area, before the correction starts. That's when the Fed starts cutting rates. This would be a rate cut cycle that starts after the correction's already after we've already had it and it's transitioned into a bear market. Again, the last time this happened, and one of the only times this happened, was that 73, 74 bear market, where just like 2022, the market was correcting as the Fed was hiking rates. That usually the Fed hiking rates is actually really bullish for markets, and the last time it wasn't was 73, 74. let's take a look at the major sectors and how they performed here this week. So again, you can see over the last 3 months, technology, communication services, this is the leadership you want, right? If we're going to be bullish, we want these sectors to lead the way higher. We don't want financials and energy and industrials and materials to lead the way higher. Yes, they are economically sensitive sectors, but they're also not very big, right? There's, bull markets don't start with the CAPE ratio at 30, number one, which is where it's at right now. Last time we got a Copic curve buy signal, the CAPE ratio, at least the 2008, 2009, the CAPE ratio was at 15. And even the 15-16 Copic curve buy signal, we had a CAPE ratio around 25. Now we're already at 30 as we're getting this buy signal. We're at 29 when we got this buy signal. And you can see that, the top 7 companies, not including Berkshire, if you look at, Tesla instead of Berkshire, the kind of the Fang Man type stocks, but take out Netflix and replace it with Tesla. I mean, that's 25% of the S&P 500. It is actually 50% of the NASDAQ 100. Like, that's not how bull markets start. That's a tremendous concentration. Microsoft and Apple make up 25% of the NASDAQ 100 by themselves, just 2 companies. When you look at the makeup of the S&P 500, they're over 13.25%, almost 13.33%. That's not how bull markets start. To be that concentrated. That's generally how bull markets end, with the CAPE ratio, like I said, as high as it is. So again, another kind of factor as to we do not want, we don't want these areas to lead us higher, because they're not the biggest areas of the markets. We want technology, communication services, discretionary to lead us up as long as they will, until they have just gotten so long in the tooth that we rebound. We want these areas to lead the way higher after that heavy concentration has resolved itself. That's when you'll start to see some of these other areas pick up, take the lead from whatever new low point we've developed. And that obviously hasn't been the case yet. So this would be good if we were below the 200-week moving average and bouncing. But the fact that we're not, and we're still very highly concentrated, not so good, right? So again, another way to illustrate that is looking at the Qs and how they perform relative to IWM, right? So, with as bullish as we are here, once this starts to roll over to the downside, and you can see, look at the MACD on the weekly chart. Look how bullish it's gotten here this past week. And it's one of the more bullish levels outside of COVID. It was way more bullish than these two. And the CCI as high as it has gotten. The RSI above 70. It didn't even get above 70 there. When this starts to falter, then that's an illustration. That when this starts to really break down, when it broke down here, was bullish for the markets because that was the reopening trade coming off of the COVID shutdown. We don't have that right now. And every other time we drop, as you can see here, that's bearish for equity. So if we start to drop again from this 1.8 level, as bullish as we've been, that's not going to be bullish for risk appetite unless, again, we're not reopening from a shutdown. You could say China is, but that's not, what's driving the financial sector doing so well and all of that, and industrials and it's only one market there rather than the whole global market. And that's that's not to say what's been going on with EFA, right? And as bullish as EFA is, look how strongly bullish EFA has been over the last last 6 months or so. It was so much more bearish, but now it's like really, but it's made such a strong run this year that it's really caught up to where the S&P has made a strong run up to the upside, up to that 23% retracement level. Look, it's about to cross the 23% retracement of the post-COVID rally. The S&P is actually a little bit lower than that, but the S&P didn't even get below 50% on the retracement, on the pullback, or below the 200-week moving average. The EFA did get way below the 200-week moving average. well below the 50%. Got all the way down to 78, close to 78 before it rebounded. So it's made a big rebound to the upside. And again, just like how parabolic is that, and how much can we really trust that move? I mean, that's a pretty dramatic parabolic move that's hard to sustain with a nice steady trend. When you take a look at the rate of change for EFA over the last 26 weeks, let's go to a weekly chart, and then we'll go to 26 here. And here, let's zoom in so you can see that. So we're up 30%. EFA is up 30% over the last 6 months. I mean, again, coming off of COVID, coming off of 2009, pretty much rivals those moves. So that's a dramatic move to the upside that, you know, relatively parabolic, that you don't see. Like, you know, obviously the S&P is not up. The S&P is not up 30%. It's up half that. Your Russell 2000 is up only 5%. EFA is also up, EEM, sorry, is also up 16% like the S&P. Your NASDAQ, of course, a big driver, but it's only up 22%. So EFA has been a big mover over 6 months. And again, how much, I mean, that's a big factor that has to do with what's going on right now with the US dollar. And the US dollar, as bearish as it is, maybe starting to develop some kind of its own low point and base, especially if yields start to rally. You'd expect it will help bring the dollar up with it. And that will start putting pressure on a very overbought segment of the market from a risk appetite standpoint. All right, so for our trade idea today, I want to take a look at Boeing. So Boeing ended up having a pretty down day. One of the few stocks that really dropped sharply. Obviously, a gap down. The intermediate line got up to the upper reversal zone. Obviously, it's been all week kind of there without getting above it. The momentum in the near-term line peaked up there, but now rolling back down, obviously, with this move down almost 2.5% below the 30-day moving average. So a relatively significant move from that perspective. The drop got you below not only the 30-day moving average, but also the 8 and the 17 on the same time. So again, dropping below multiple moving averages is more significant than just dropping below one, right? So here's a big gap. You only got below one moving average there. But getting below a bunch with the MACD and stochastics rolling down, big chunk in volume, that's a little bit more significant. Obviously, you have 3 red arrows. Whoops. You have 3 red arrows as well. You can see the 3 red arrow chart here. So 3 red arrows, again, with a big spike in volume. As you can see there, it can be a relatively bearish sign, more bearish than obviously a 3 red arrow signal without all that volume that can actually be a buy signal. You take a look at some of these other oscillators here. For example, the directional movement index, big spike up on the negative indicator, higher than what we've seen. Then positive dropping down there, not quite below 20 yet, but working its way down. Looking at the RSI and the CCI, both dropping to bearish levels, dropping below 50 on the RSI, dropping below the minus 150, or below 0, but getting below minus 150 on the CCI. Getting below the Ichimoku cloud, just barely, but you have a negative rate of change now. You're below the cloud. You haven't even started the bearish trend yet, so we're not necessarily oversold per se. And then again, you can finally see from a Keltner channel, we didn't get outside the band or the Keltner channel, but we did drop into the lowest quartile with the positive momentum that we've had changing and starting to work its way lower. So again, kind of like the NVIDIA trade, it was an opportunity here to be a little bit more aggressive with this trade, because again, the move that it's had and how bullish it's been, and the opportunity just to be a little bit speculative with the markets as bullish as they are if resistance holds. And a stock like this, which is already breaking down, follows suit. So you can see we went for the 180, 185. That's right about here, going out to the May expiration. Let's see here. Let me just get rid of there's the trade that we put in during our Market Outlook Live video before the market closed. Half a position size, and then you can see the market kind of rallied into the close there. and about a 5-to-1 reward to risk ratio if it plays out. So pretty speculative move if it works its way back down. And the idea behind that, here, let's go to the Bollinger Bands. The idea behind that, this target 380-ish, you can see 179 is one standard deviation, and we needed to get to 180. So that's, that's kind of in our favor right now. Here, let me reset parameters on this. There we go. So there's your one standard deviation at 179. So you can see that where that puts you is actually like into this range of volume, and it's not very far. Like when you look at the move that it's made, let me get rid of that. Here, let's get rid of some of these other drawings too. We'll move that one, and we'll move this one while we're at it. And then we'll draw Fibonacci lines here based off of this rally that we've had off of this low. And then to move higher up to right there. So you can see how we're still kind of in a noisy period between, but you notice that we're so top heavy with this volume node that it's very easy to drop down to the 38% retracement, down towards 185 or a little bit lower, and that's kind of where where we would get our maximum gain on this trade. Again, with as small of a risk as we have, 5 times the reward of that small risk. So that's kind of the idea behind that. I like the NVIDIA trade just being a little bit speculative, going for a bigger reward, knowing that as bullish as we are, and if we continue to bounce back up and fill in that gap, it's going to be really easy to close this out early with a $100, $200 loss, which is no big deal compared to the maximum loss, which itself is not a big deal compared to the maximum reward we're shooting for on a position like this. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen that takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Subscribe to us at MarketScholars.com for free. Follow us on Twitter and Facebook as well. Have a great rest of your weekend, everybody, and we'll see you all on Monday.